Alphabet isn't usually thought of as a value stock, but longtime Warren Buffett follower Mohnish Pabrai of Pabrai Investment Funds says it is, and that as the market gets more expensive, finding value has become more difficult. He explains in today's Spark Value Edition.
I think the interesting thing about the U.S. markets presently is I think they're either fully priced or overpriced. And of course, if we see sustained period of low interest rates, then they may actually be underpriced, but we don't know where interest rates are going. Assuming they're going up, they're either fully priced or overpriced, but not only that, in a sliver of the market, it's interesting, it's not like 2000. So we have very high valuations for Facebook and Amazon and Netflix and so on. And the difference between 2017 and 2000 is these are real businesses. These are real businesses with real cash flows, and they will be with us for a long time. The question is, are they fairly valued or overvalued? And that's hard to tell. So my answer to something like that is to stay away.
But you do own Alphabet.
I do, yeah. I do own Google, and Google actually has not participated to the same degree. Even if you look at the year-to-date growth in caps, they have not participated. But Google is an unusual company. I think it's
and you've been in it for a few years.
Yes. We owned Google. I think, I don't know, 2 or 3 years. But Google is a company that can innovate outside of its adjacencies. There are very few businesses that can innovate in spaces that they're not in. Google is a company that is working on these lenses that detect your blood sugar levels automatically, or self-driving cars or flying cars and all of these things. So they are able to innovate in completely unconnected areas. It's somewhat similar to Elon. Elon is a guy like that, but they're in different companies.
I'm interested that you think that's a good thing, and that it's not one of these things where they have a business, they have a moat, they're sticking to their knitting, and that's often what you hear from more of the
I think in many ways Google is the ultimate Thando business. So what they do is when they made, I think what they call them side bets. I think that's their term. All the other bets, right? The other bets. So the other bets are all a rounding error on cash flows, especially when we have the new CFO on board. So they're spending in the tens and hundreds of billions on these other bets, but the mothership is producing billions, tens of billions a year. So the other bets aren't really going to move the needle in a negative way. I think Google is a kind of company which is very unusual compared to the range of, I think the only other company that's similar to Google, I would say, is Amazon. And I think that
so many of their bets have turned into these amazing new.
Yeah, I think Jeff Bezos probably is one of the top 5 business leaders in the last 100 years.
Wow.
He is the best of the best. And so I'm a huge fan of Amazon, and I wish I were a shareholder.
But you can't get in here. How about the biggest investing mistake you think you've ever made?
Well, there have been lots of mistakes, but the biggest mistakes have tended to be where I have ignored the leverage on the balance sheets, and they've come to bite me. We had an investment in a mortgage company in 2008. Delta Financial went to zero. We had an investment in a zinc manufacturer last year, which again had balance sheet issues, and it also filed for bankruptcy, went to zero. Both investments were very different. The common theme was they both had debt that they couldn't service. And so I have gotten more reinforced in my head that look for the alphabets of the world, which just gush cash without debt.
We'll have more with Mohnish Pabrai in the next hour, getting his take on GM and the autos, including asking about David Einhorn's proposal to split that into a dividend and the capital appreciation share class. If you want to skip ahead, you can watch the whole thing right now on cnbc.com/pro.
I'm still wrapping my head around the fact that the tens to hundreds of billions of dollars they spend is a rounding error for Google or Alphabet.
And how about his point about Jeff Bezos of Amazon, one of the top 5 business leaders of the last century? I don't know if anybody would even argue that point.
No argument here. That's fair. A lot of people don't don't want to buy the stock because they think it's too expensive.
And he won't buy Tesla either, even though he loves Musk.
Okay, there you are.
Buffett could change his mind about investing in airlines, then perhaps Buffett follower Mohnish Pabrai can change his mind about investing in autos. Pabrai tells us why he chooses to invest in GM over Tesla in the latest installment of the Spark Value Edition.
I've always detested the automakers, unionized, very high capex, you're subject to consumer taste, it takes you 4 or 5 years to get a car to market, and in the meanwhile the market can change, and all these things that are very hard to predict. But what ended up happening is that after GM and Chrysler went through bankruptcy, as I studied them, they became completely different companies. And so Detroit went from being one of the worst places on the planet to build a car to one of the best. And the reason I ended up in these names was because when I looked at, for example, Fiat Chrysler, I think in 2012, they were basically at one-time earnings.
Wow. And
this is one-time, 2017, 2018 earnings, but it was very cheap.
Yes.
And so cheapness will let me get over some dislikes.
And some changes to the industry too. Do you know David Einhorn?
I know of him, I've met him a few times.
A couple of your positions overlap.
Yes.
One of them is General Motors, and he has pushed for the stock to create two classes, one for the capital appreciation, one for the dividend. What do you think of this idea?
Yeah, I don't think it's a good idea, so I'm actually with GM management on that. I think a simpler and better approach for GM to take, it'll be hard for them to do this, but a better approach is eventually eliminate the dividend. Since we have a cyclical industry, why not go no dividend? And GM has a really good capital allocation framework for returning capital via buybacks. In any case, buybacks are a better way to get money to shareholders because you don't have Uncle Sam in the middle.
Would that depress the share price because I know there are people in it now who are partly attracted by the dividend because it got so high when the stock got so cheap. What happens if they leave and the price?
I can't see GM, so first of all, we shouldn't be making decisions because of the stock price. That's not a good idea usually. And I'm not saying this to drive the stock price up or down. All I'm trying to say is that if the business delivers cash flows and it's run effectively, eventually the stock will reflect it. So I've been a shareholder in GM for 5 years. We haven't seen much of a return, but I think Mary is fantastic. I think the company is run really well. They're firing on all cylinders. One of the things that we don't control as value investors is we don't control the time it takes from a value stock to get appropriately priced. That is up to Mr. Market. And so we don't really have, we don't particularly have control over that. So with GM, eventually it'll get to the price it needs to get to.
Which you think is?
With or without a dividend. Probably, I would say, it needs to be somewhere between a 50 and 100% higher than present prices.
So let me ask you, because you mentioned time, is time working against these automakers? Because look what happened this past week. Tesla's market cap overtook that of General Motors, but what is this company going to look like in a couple of years?
Well, so first of all, with Tesla, I don't short anything, but I don't think it's a smart idea to be buying Tesla stock at present prices, even though I think Elon is fantastic. But no, I don't see the auto business has changed quite dramatically. It's not anywhere near as cyclical as it used to be. The US auto market has quite a room to run.
What does self-driving cars do to all of these investments? What do you think about how this is going to unfold across the industry?
So first of all, between us girls, there isn't going to be any self-driving cars as we think about it for at least a couple of decades.
You really, for a couple of decades?
So we will see self-driving trucks.
Like auto?
Way before, auto, just a Tesla pass by on. Because self-driving trucks is a different framework. When we are driving a truck, let's say from California to New York, you can have a driver get the truck to a highway. And then you can have someone else on the other end take it from the end of the other highway. And the central point is about highway driving. That is easy to automate and get the driver out of the steering wheel. But in self-driving cars, the last mile is very complicated, and it's very complicated in each of the different scenarios you might think about.
And it's the most driven mile.
Yeah, and so I think I think we will see a lot of advances in driver assisted technologies, but I don't think you're going to get the driver out of the seat for a long time.
Our thanks again to Mohnish Pabrai of Pabrai Investment Funds. You can watch the full interview uncut right now on cnbc.com/pro. Like I said, I don't short anything when it's talking about Tesla, but
it's a good thing he hasn't in the past.
Yeah.
But what I really liked about that is where he said keep it simple in respect to splitting GM into two different stocks. When you complicate things, as we've all seen over the years, things just it has bad outcomes. So we want to simplify things rather than make it more complicated. So to get rid of the dividend, I mean, he had some very valid points there.
It's a cyclical business.
Right, and so you don't run into cash. And again, the buyback over a dividend, the tax treatment is much...
and you don't have the signal for shareholders if you ever tweak it, or certainly if you lower it or eliminate it for a period of time. The other interesting thing, though, is that his argument, I'm not sure this made it in there, was that he thinks that the auto sales plateaus at this high level. So it actually might look a little bit less cyclical for the next many years, just because it's kind of like there's this pent-up demand for new cars, and that might keep us from, falling from peak levels to maybe just hanging around there.
Right, I mean, we've seen in housing, boating, cars, the age of the fleets and the structures are aging, so I mean, you can tend to see a leveling off here, but I don't think we're going to see a big dip in auto sales.
You're following the boating stats. The average life.
The boats are much older than houses. There's a very big replacement cycle.
Yeah,
Marine Max.
people are crazy. I mean, I don't know. I've never owned one. A former top